All right, everybody, it's your boy Ed Diaz, and today I'm mixing it up yet again. Why? Because I want you to know that, yes, I can do vanilla loans, a lot more really creative stuff. And I'm kind of known for being extremely creative and being the guy that if I can't do it, nobody can kind of thing. And so, in that vein, I have a special guest, Justin Hollis of Greenbox Loans. These guys are super outside the box. By the way, these are lenders that I work with directly. Don't see them because they're the real wizard behind the curtain if you've ever watched The Wizard of Oz. So on that note, thank you so much, Justin, for joining me today and really do this, because I know this probably doesn't happen a lot for you because you're always behind the
It
scenes.
doesn't, but thank
So
you so much. I'm
pulling
glad
you
to be
out.
here.
Very,
Thank you
very
so
good.
much. Okay, so let's get started. I'm gonna share my screen here and
Yeah.
go ahead and
So
get started
first
here.
off, tell me a little bit about Greenbox loans.
Okay, so we are
Know about
your
you.
premier non-QM lender. We've been around for about 9 years now. And we are, we can say we're the lender who's had the most lenient guidelines, I would say, out of all the non-QM lenders out there. We end up taking a lot of fallout from other lenders and things like that. And we can do a lot of things that other non-QM lenders cannot do. So when it comes to, we're not your cookie cutter lender. We're here to actually make solutions for your borrower. We're here to actually kind of review your compensating factors. If we need to make exceptions, we do. And we're here to fund as many loans as possible on the
Very good. So
non-QM
let me
side.
dissect this a little bit for those of you who have no idea what he just said as far as what's QM and non-QM. So non-QM is non-qualified. Just think of it this way. You have two buckets. You have vanilla stuff, that's your qualified mortgage. And then you have the non-vanilla, very cool stuff, which is the non-QM. This is the stuff that in reality in life, most people don't fit into the little box. This is where we live, right? You
Mm-hmm.
fit into the little box. What do I mean by that? You're the perfect person. You're putting 20% down. You got an 800 credit score. You've been working for Google for 22 years. Perfect, right? Everything is great. Everything is spotless. That would be a QM loan, which I do all day long. Those I call vanilla loans. And in that situation, because you are that VIP client, then really what we're talking about, rate, right? Get you the best rate. And I have a methodology for getting you that best rate. And it has a lot to do with me doing some technical analysis and research. Talk about that in another video. And also you're looking at terms, right? What can we do for you as far as fees and those kind of things? So that is a different type of client. Here today, this lane is about the non-QM, the non-qualified mortgage client. So maybe you're self-employed. You know what? Your taxes don't show any income or any money, right? That would be one. Maybe you live in another country and you have zero financial footprint in the United States, but you want to buy property, we can do a foreign national loan. Maybe you're a person who doesn't have any kind of immigration documentation. We can do what's called an I-10 loan, which is an individual tax ID number. Because you have filing taxes, right? And you have a tax ID number, but you don't have a social security number. We can do deal. You're looking to buy an investment property, but you know what? Come, not really so great. You can use the rents on the property to qualify you. Hence the debt service coverage ratio, otherwise known as a DSCR loan, which we're going to attach to 1007, which is an addendum to the appraisal for the rental survey. And we're going to qualify you based on the rents and not your personal income. So on that note, let's get a little granular here, Justin, and I'll let you take it away.
Perfect. So here are the programs that we can offer. Before I get started, I want to let you know that our niche is bank statements, I-10, and DSCR. Want to just kind of go over these little graphs here, these little tables. So being, bank statement being our niche here, we do have 5 tiers of bank statement programs. We also have 5 tiers of full doc. We have your full doc for anything that falls out of your conventional bucket, non-warrantable condos, jumbo, anything like that, mortgage lates, housing events, okay?
Low credit scores, right?
Exactly. As you can see, we will go all the way down to 620 here on the normal full doc program. And the reason that these are great is because as the top plus tier programs here, these have the very lowest rates, and therefore, they have the most restrictions. They're for your borrower who is the closest to that conventional bucket, who probably is falling out of that for one reason or another. And then as we go down this list, these the rates get a little bit higher as you go down, but the programs become more lenient with the restrictions and everything like that. Okay. When it comes to our normal tier programs here, these can go down to 620, require 36 months from a housing event instead of 48 months like the two top tier programs. Here, we do allow 24 months from a housing event, and then the bottom tier is 12 months from a housing event. And as you can see,
Explain what a housing event is.
so a housing event is anything such as short sale foreclosure, bankruptcy, deed in lieu, or even a modification, like a loan modification or a forbearance, we do consider to be a housing event.
Perfect. Let me jump in real quick.
Mhm.
Here's how it works on a vanilla loan. You got to wait 7 years. Okay. That's how it is. Notice how they've truncated this tremendously. Keep in mind that non-QM loans are really accommodation loans. So is your rate going to be higher to compensate because it is riskier to the lender? Of course. Think about it. If you were writing the check, obviously your terms are going to be different depending on the level of risk, just like anything else. You invest in the stock market, you invest in smaller companies, they're riskier than investing in an IBM. Yeah. And therefore, the risk profiles are totally different. This is an accommodation type of lending that otherwise you would not be able to purchase this property. Bank statement loans. Let me talk about that for a second. So when he references that, what he's talking about is, again, you're self-employed. Taxes aren't showing any money. Guess what? You have really great cash flow. How do we know that? Because we're looking at and analyzing last 12 months, for example, or last 24 months, your bank statements. To give you an example, I had a client who was a daycare. I did the traditional analysis of their income. It's called the SAM analysis. That stands for Schedule Analysis Method. Why schedule? Because it's a Schedule C on your personal tax return as a sole proprietor. And her income was $5,417 a month. Unfortunately, in California, that's not going to do much for you, right? However, when we ran the bank statement cash flow number, it came as $32,000. Totally different planets, planet Earth and Saturn, right? So her ability now to purchase a property, which by the way, she was going to live in it, but also use it as part of her day care, because that's usually what happens, now gives her also more leverage for her business in this situation. So it is night and day. So the message here is that regardless of your situation, don't let your emotions get in the way. Reach out to me. Let's have a conversation because A, I don't bite, and B, it's not going to cost you anything. And that way we can talk it out because you have no idea how many programs we have. This is just kind of a snippet that Justin is going to.
Exactly. And if
What
I may,
else is your specialty?
so just before moving forward, I want to expound on one thing that you said there. When it comes to the housing events, each one of these programs also get more lenient on credit. So these two top tiers here usually want 0 by 30 by 12. This one will allow 1 by 30 by 12. The NP tier will allow 0 by 60 by 12. And then the RH tier is 0 by 120 by 12.
By the way, what he's talking about is number of events, like, right, like late,
Yeah, mortgage
over
lates,
how
yes.
much time, right?
Exactly.
Whether it's a 30, 60 or 90-day late or a 120.
Within the last 12 months.
So when he says one, for example, 30, 12, that means 1 30-day late in the last 12 months. That's how you say.
And then one more thing I want to expound on, you were speaking about the bank statements. You know, if they have write off too much on their taxes, want to use the statements program, we do have a few ways that we can calculate the income depending on what would be best for your borrower. So these two first beginner ways, these are 12 or 24 months with a P&L, or we can do 12 or 24 months with a business expense letter. These two income calculation options are interchangeable. We can either take the P&L or we can either take the business expense letter. One thing that is great is the business expense letter has no number figures on it, but it does give us a minimum expense ratio of 10% plus all of the verbiage that we would need for the borrower. Okay.
By the way, that's important, folks, because let's say we don't go with that letter. Well, they're going to hit you for a higher expense ratio. But if your CPA is saying that no, your particular expense ratio is 10%. I mean, obviously your debt to income ratio is going to be completely different, right? These are the little nuances. Remember that the devil's in the details, and this is what we're talking about here. This can make or break a deal depending on the price point.
Mhm, exactly.
Excellent.
And then the two other ones that are big, we have a 50% net margin that is available. I don't really use that one too much, but the other ones that we do use are the 3-month statement option with a 24-month P&L. This is for your borrowers who have overdrafts or NSFs in the past, 12 months. And then we also have a 24-month P&L only option. And this is going to be the closest thing to our stated program that we are going to come to, because we will take whatever income your CPA puts on that P&L. It must be prepared by a CPA or EA, but we will take
EA
whatever
being
you
an
put.
enrolled agent, folks. They're not a
Exactly.
CPA, but they have a certificate to do from the IRS tax
Mhm.
returns.
And then you can see here, if you guys want to take advantage of those programs, they come with a few little restrictions: 720 minimum FICO, 43%
Yeah,
DTI,
yeah,
80% LTV.
that makes sense. Excellent. Well, Justin, look, I know we did this pretty quick, but folks, the message here is that this is the kind of horsepower that I have. I have these type of lenders back pocket. So again, reach out to me. Let's have a conversation. And even if you can't do it now, let's prepare you for tomorrow, because tomorrow's coming really, really quick. Don't squander your time. Don't allow your emotions to get in the way of the purchase property. And don't let anybody tell you that right now is a horrible time to buy. Call me and I'll explain it in detail as to why right now in the next, say 12 to 16 months, be your window of opportunity before prices go up and rates come back down. Thanks again, Justin. You have a
Thank
great
you,
day,
Ed, for
my
having me.
friend.
Appreciate you so much. Thank
Thank
you.
you for the information.
You're very
Really,
welcome.
really great stuff.
Thank you.
Take care,
Have a great day.
everybody.
You too. Bye-bye.